Welcome to Yahoo Finance Live and happy Friday. I'm Shauna Smith alongside Dave Briggs, and let's get you up to speed on everything that you need to know at 3 p.m. Eastern Time. Well, falling Domino's bank stock sent the market on a wild ride today as fears over financial stability resurfaced. Germany's Deutsche Bank was the catalyst today. Its shares falling as the cost to insure against default soars, looking at a loss of just about 3%.
Plus the aftermath. TikTok CEO got the grilling of a lifetime yesterday in Congress, but what are the next likely moves in this story? We'll speak to several guests throughout the program and get their biggest takeaways.
And later, we are breaking down all of the big stories you might have missed this week, from the Fed to Bitcoin's moves. We decode the biggest headlines coming up later in the show.
But first, let's get you up to speed on more pressure in the banking sector. Shares of Deutsche Bank trading lower after a price spike in credit default swaps on Thursday night has proven to be a warning sign for wary investors following the recent collapse of Swiss bank Credit Suisse. You can see shares down more than 3.1%. Joining us now to break down the latest with Deutsche Bank and what it could mean for investors here in the U.S. is Reese Williams, Chief Strategist at Spouting Rock Asset Management. Good to see you, sir. So here is the word from German Chancellor Olaf Scholz, who said there is no reason whatsoever to be concerned. Is he right?
Well, we can only hope so. Obviously, the last weekend is remembering of last weekend when the Credit Suisse CEO said everything was fine too, and the bankers in Switzerland also thought everything was fine. So, I mean, the difference is there is no big brother for Deutsche Bank to go to, and so I do think they will pull out all stops. And really, right now you have a liquidity issue, not a credit issue yet. So I think what we need to do is the federal bank, the Federal Reserves of the world, and the ECB in this instance, really needs to protect the banking system as job one and kind of worry about inflation later. And I just think as long as they would, have that message, each and every hour of each and every day, I think we could probably get through this without the huge kind of hard landing risks that we potentially have for ignoring a banking crisis.
Reese, you mentioned that the need to pull out all stops. You just talked about what the regulators need to do. What is Deutsche Bank? What do we need to hear from some of those executives right now?
Well, I mean, the problem is, no, it's hard for the CEO to get on TV and say everything's fine. I really do think everything's fine with Deutsche Bank, though. They do have adequate capital levels, and I do think also, they unfortunately they do have, I think, lots of relationships with other banks, and so potentially you could move your money from Deutsche Bank to JP Morgan, just as the same phenomenon that's going on in the regional banking crisis here. So that's why I do think that protecting the system is very important, and I think every regulator needs to think about that, and I think say basically the Mario Draghi line of we're going to do what it takes, and I think Deutsche Bank is a systemically important bank and needs to be protected at all costs.
Reese, do you get a sense of who's next in this game of whack-a-mole, and how much of it at this point is purely emotional?
I think it's mostly emotional now. Really, what we have is liquidity problems, not a credit problem yet. But it's one of these things where, at least in the U.S. banking system, with the regional banks all going down dramatically everywhere, there's going to be less loans given, and because their cost of funds are actually going up in this period of time, they're going to charge more for those loans, which means customers are going to have to pay more for loans, which is deflationary, not inflationary. So I really do think the Federal Reserve, all politicians need to think about one thing, and that is let's save the banking system first and foremost. Let's get calmness there, and then we can worry about inflation a couple months from now. But I think really job one is protecting the system, because what's going on right now is the Fed is looking at the rearview mirror and not looking at the windshield whatsoever.
Reese, all of the concern right now that's playing out within the banking sector, not just the European plays, we also seen it a bit reflected in some of the larger U.S. banks, specifically also the regionals. That's obviously where we've seen most of the selling here in terms of the U.S. banks. How much of that fear do you think is overblown, if at all?
I think currently the fear is overblown, but this is all a confidence game. And like I said, I think the health of the economy is pretty good. the coincident indicators are fine. The question is, if this continues, what happens to the go forward? And I think that's where we need to look firmly in the windshield and say, we need to stabilize things now. And I do think, for instance, some sort of discussion about guaranteeing all deposits in the U.S. would go a long way to stemming the crisis. I think until something along those lines happens, and I realize it probably needs congressional authority, but these guys can stick around a weekend. Let's get this done. There was a lot of tough votes during the 2008 crisis, much tougher votes actually than that, because protecting depositors is not protecting stockholders. I do think the effect will be, if you protect depositors, you will protect stockholders, but you don't have to make that de facto pledge.
And Reese, if the Fed were looking out the windshield, to your point, what would they be focusing on and how would they act?
Well, for instance, and this is just how they calculate CPI. The CPI inflation, I think, is actually less in reality than the stated number, and the reason is, rents are a quarter of CPI, and rents are actually going up about 2%, not the 8%, because the way they calculate it is sort of a weighted average of the last 12 months. So I think the problem with what they're doing is they're not looking at the kind of what's going on real time, that things are really starting to slow. And their mission seems to be, we've got to be backing very tough on inflation. And that, to me, is, they've won that battle more or less. Now what they need to do is, stop putting on the brakes to avoid a hard landing. And I think that's really what they need to, have a consistent message of, instead of the, some people saying something, some people saying the other. Bullard saying that, I think rates are going to go higher. Well, that's just not very helpful right now, and I think that's not what we need.
And certainly adding to some of the jitters out there. Reese Williams, always great to speak with you. Thanks so much. Well, turmoil in the financial industry sending many of those bank stocks lower. The XLF, the financial sector ETF, has fallen about just over 13% in just the last month, is now approaching levels that we haven't seen since the great financial crisis. We want to bring in Ryan Dietrich. He's Carson Group Chief Market Strategist. Ryan, it's great to see you on this Friday. Lots to get into, but I know you're specifically watching the XLF, some of the movement that we've been seeing in the financial sector. What is that signaling to you?
Well, that's right. I mean, clearly we know what's happened in financials and banks. But I'll tell you, that 30 level, nice big round 30 level on the XLF, that was the pre-crisis peak in 2007. So there should be a good deal of support there. We found support there a couple times recently over the last several years. So we're there again. Just put it like this. If we go below 30 on the XLF, I think, we think that this is going to be contained. We think it's just a few bad banks. Yes, it's been volatile. We can get into all this stuff. That'd be more risky, though, if we break that 30 level by a significant area. We don't think we will, but we're right there.
And seasonally, you say historically this is just the March lows that we go through. Why so is that historical trend? And do you think it gets worse in terms of equities?
Yeah, we don't think it's going to get much worse here. That's right. You look at the last 20 years, right? March has been a low multiple times, 2003, 2009, 2020. To be very honest, might be a little more random than not, but think about those three times, right? 2003, war with Iraq, 3-year bear market, 2009, financial crisis, stocks cut in half, 2020, shut the world down, COVID. Those were very negative times. Most people didn't think, what I should do? Go buy some stocks right now. And we're not saying just blindly buy, but I'll tell you, when his expectations get low and you look at sentiment polls and different things, there's not a lot to be optimistic about. I mean, I can list some things for you, sure, but overall, there's a lot of worry out there. From a contrarian point of view, that could be a pretty good thing.
So Ryan, then what do you like in this environment, given the fact that there is so much uncertainty? And a lot of people are asking whether or not some of the selling that we've seen, specifically in Deutsche Bank today initially, whether or not that was overblown.
Yeah, well, I'll just do this. I have to do this. I went to Xavier University, got my X pen, got to do
We
an
see
X
it up
on
there.
here. They're in the Sweet 16, so I like Xavier tonight, but I know her for a reason. You think about, we're sticking with industrials, right? Industrials, they've done really, really well. They're not that far from all-time highs here, and as you have this weaker dollar, you could have a little bit more earnings growth. Now, we also like energy. Energy been hit hard, I get it, but I'll tell you, we don't see a recession. Look at just today's economic data that we saw. It doesn't look like a recession recession to us. And I know the credit crunch and things are potentially coming. So a slowdown, sure. But energy's been beaten up. That could be one that's nice. And the third thing is kind of a barbelled approach, if you will, gold. I know a lot of guests have probably talked about it. Gold went nowhere for 12 years. It went up for 12 years. Then went nowhere for 12 years. That dollar weakens like we think it can. Gold could be another area that, if everything keeps spiraling out of control, that could be a place you could park a little bit in there. But we still like, the cyclical value or industrials and energy. I think those are still going to do pretty well the rest of this year.
You did mention the X, so I have to bring it up. Texas wins this game. I'm sorry, my friend. It is National Cocktail Day. Next round of cocktails. We'll bet on this. Fair?
That sounds fine. I hope you're wrong, but that sounds fine with me.
Rodney Terry's team goes to the national final and loses to Alabama, but I'll leave that for another day. You say there is a fundamental disconnect between the economy and the stock market. Why so?
Yeah, that's right. I kind of talked about it a second ago with industrials doing well, but look at like semiconductors, right? Semiconductors just a week ago today broke out to a 52-week high relative to the S&P 500. What in the world does that mean? Well, it means there's a lot of strength there. I took a look the last 20 years when that happens. It's happened 8 times. A year later, you didn't have a recession. 2 years later, you didn't have a recession. So we are aware of all these very legitimate worries that are out there. But when you look at some of the areas that are leading and doing well, we're just not really buying the end of the world scenario that so many people are talking about. And from that contrarian point of view, it still could be an opportunity if we can avoid that recession like we think we can. One more quick one, guys. On April Fool's Day last year was the 210 inversion. You can't make that up. That's when the yield curve inverted. So we've been about a year with this inverted yield curve. And again, look at the economic data. It's still hanging in there thanks to a stronger than expected consumer.
Well, Ryan, what happens if the Fed continues to raise rates? We heard from Jay Powell. He sounded like he wasn't afraid maybe to raise rates even further from where we are today. What happens to equities in that situation?
Yeah, we don't anticipate that if they were to just stay aggressive. That could upset the apple cart. A lot of smart people have been saying what's going on with SVB and the fallout. That's equivalent to 2 to 3 25 basis point hikes. That's kind of doing the job for the Fed. They probably have one more hike, but I'll tell you, the bond market pushes the Fed around when you just again today. What are yields doing today, right? The bond market saying, Fed, you are about done, and the Fed tends to follow that. So it's a really interesting situation. But I'll just look at the inflation data, look at the supply chain data, time to delivery, prices paid. Those things are coming back. The guest right before me talked about inflation, how some of these positives that are going to be here in 6 to 12 months. And we think that's the case as rents and things like that start to fall into the inflation data. So the Fed really probably doesn't have to continue to hike here. The Fed did a whole bunch, and then they slammed on the brakes, and that's kind of what they do. But we think maybe one more hike, and then they're probably done here.
All right, we will see whether or not you're right. Ryan Dietrich, always great to have you, and good luck to Xavier tonight.
Longhorns, man.
All right. Go Xavier. Sorry, go Xavier.
All right, Ryan, have a great weekend. Before we go to break, we also want to get one more check of the markets here. We have just about 50 minutes to go in the trading day. Dow holding on to gains up just 42 points. S&P in positive territory. The Nasdaq, though, just below the flat line. Investors trying to shake off some of the concerns, some of the jitter, some of the worry that is playing out in the banking sector. We have Deutsche Bank off just about 3%. So off its lows of the day, was off about 7% in earlier trading. This market check sponsored by Tasty Trade. Well, we are just getting started here on Yahoo Finance Live. Coming up, scrutiny mounting over TikTok's ties to China. We will speak to FCC Commissioner Brendan Carr on his biggest takeaways from Thursday's hearing. And wrapping up a big week for the Fed, investors hoping for a quicker end to rate hikes. We'll discuss how the central bank may plan to redirect its path to help get the economy back on track. We'll be right back.
To the American people watching today, hear this: TikTok is a weapon by the Chinese Communist Party to spy on you, manipulate what you see, and exploit for future generations. A ban is only a short-term way to address TikTok.
ByteDance is not owned or controlled by the Chinese government. It's a private company.
TikTok's source code is riddled with backdoors and CCP censorship devices.
You damn well know that you cannot protect the data and security of this committee or the 150 million users of your app.
We do not promote or remove content at the request of the Chinese government.
Wow. If Thursday's TikTok hearing were a book, the title would be Show Chewin' the Terrible, Horrible, No Good, Very Bad Day. Will that one day, someday lead to an all-out TikTok ban? And if so, how might that work? For those answers, we're joined now by FCC Commissioner Brendan Carr. Great to see you, Mr. Commissioner. Thanks so much for being here. How would you characterize the TikTok CEO's testimony, and how safe ultimately is U.S. user data when it comes to the Chinese government?
I think you put it right. Look, I can't imagine yesterday going any worse for TikTok. I personally sat in that exact same chair, the exact same hearing room for the exact same committee multiple times, and I've never seen anything like it. It really united Republicans and Democrats. Whatever odds are that people were putting on an outright ban on TikTok before that hearing, I think you had to substantially raise those odds during the hearing. The one thing he had to do was establish some level of trust with the committee, really with anybody, and he failed utterly in doing that.
Commissioner, I think there's lots of questions out there. I mean, obviously, this app is massively popular. TikTok saying they have 150 million American users. How exactly would a ban potentially work?
Yeah, there's different ways that you can structure it. You know, India has banned TikTok back in 2020. CFIUS, our Treasury Department, has previously required the sale of Beijing-based ownership. So Grindr was an app that was an example where they required it. So you can go this route of sort of a genuine divestiture of ties back to the CCP. We've done that. Or you can go this route of India doing the outright ban. But you're right. Look, 150 million people, we can't sort of push that to the side. When we dealt with Huawei and ZTE, these weren't consumer-facing devices. So I think it's even more incumbent than ever before on people like me to make the case and explain to people in really concrete terms why this is a real problem and why we need to potentially ban the platform.
Well, that's why we have you here. If you can explain to the American people why this is such a concern, and do you have those concerns about Facebook, Instagram, Twitter, Snap, and the like?
You know, I do have a baseline level of concern with a lot of applications and the data that they pull, regardless of whether their headquarters are in Beijing or Silicon Valley. But there's something unique with TikTok, and we have the evidence already. Look, they've represented for years very little data. In some cases, they would say no data made its way back to China. But we have those internal audio communications that show no, in fact, everything is seen in China. We have them admitting now to having surreptitiously surveilled the location of specific Americans after initially denying it, even though they had the information to know it was true. We have evidence that they've allowed CCP state media to set up accounts and target U.S. politicians for criticism ahead of our midterm elections. FBI, DOJ is investigating right now as well. So unlike 3 years ago when we went through this in the Trump administration, I would say the evidence is now public, at least a substantial amount of it, and very clear. So it's a much stronger case now than then.
So you're laying out why TikTok could be viewed or should be viewed maybe as a national security threat. What about those, some of the other U.S. social media platforms? Not so much a national security threat, obviously, but more so the data collection aspect of it. The thought here that maybe this is going to attract a little bit more scrutiny. Maybe they need more oversight. What do you think?
Yeah, I think we can do both. I think we can put some better baseline privacy protections in place. Again, at the same time, I think there's something very unique about TikTok that it's been going through this 2-year Treasury Department review. I think it's very clear, in my view, that it's low-hanging fruit. So I think we need to move forward quickly with a TikTok ban, and then you can take a look at other applications after that. But I don't think we can just afford to kick the can down the road, given that we got no protections right now while this data is going back to Beijing.
What would your message be to the millions of creators, part of an estimated $100 billion creator economy, and the estimated 5 million American businesses who do rely on TikTok for some form of advertising and or connecting with their consumers?
We need to be really sensitive to this, but I think the answer there is, in some ways, TikTok is uniquely replaceable. Unlike, say, LinkedIn or Instagram, you're not building followers. It's an algorithm that's promoting it. So I do think this can be easily replaced by other applications. Also, if TikTok agrees to a corporate divestiture from ties back to CCP, then the platform itself stays available. But I think there'll be other competitive short-form video applications where people can continue to be innovative and run businesses off of it.
How close do you think we are to that ban? What does that potential timeline look like, do you think?
Well, it certainly has accelerated a lot. I mean, it's obviously not going as fast as I would like, but usually we have these big tech hearings and people in DC get the feeling after them that nothing's really going to change. I don't get that sense. I mean, you wake up this morning and it feels like the floor is dropping out below TikTok very, very quickly. And so again, the White House has already said, apparently, according to reports, divest or face a ban. So this could go sooner rather than later, although it's DC. A default position is to assume things take longer than it should.
No doubt about that. FCC Commissioner Brendan Carr, really appreciate you being here, sir. Thank you.
Thanks so much.
All right, coming up, a name to blame. Yahoo Finance's Rick Newman explains why more critics are coming after Jerome Powell after his 25-point basis hike. That's next.
Got just over a half hour to go in the trading day. Let's check in on the market sponsored by Tasty Trade. All three of the major averages trading to the upside. You have the Dow up 105 points. Taking a look at some of the outperformers there. Amgen up just over 2%. Procter & Gamble, Coca-Cola, some of those consumer staple names pushing to the upside. Consumer staples, one of the outperformers in today's trading action. The Nasdaq also now in positive territory, up just about 0.2%.
It was another big week for Fed Reserve Chair Jerome Powell this week as the central bank moved to raise rates by another 25 basis points. But President Biden has, for his part, stayed out of the Fed criticism and stuck to his word on staying silent when it comes to central bank moves. This narrative is where we find Bidenomics today. Our Rick Newman joins us now. Rick, good to see you. Happy Friday, sir. Should he criticize the Fed?
I tell you what, this should not have been that controversial this week. I mean, it was only 1/4 of a point. We've seen way more than that several times during the last year. And yet I've seen more strident criticism of the Fed this week, and not from the loony left or the loony right, but from measured economists who are saying, what in the heck is the Fed doing? We have a banking crisis on our hands, and the Fed this week continued to do the very thing that some people say contributed or even caused the banking crisis, which is raise interest rates. It's been this super fast pace of rate hikes that has caused this interest rate risk and this interest rate differential problem at Silicon Valley Bank and some of the others. So the Fed went ahead and raised and kind of indicated we're not that worried about what might be a financial crisis. Maybe they know something we don't. Maybe they can look at data that says things are settling down in the banking system, and we think this is blowing over. But it seems to me there's a reasonable case for the Fed to at least have just taken a pause for a couple of months and said, let's just see what happens with this banking crisis, and we can always start raising rates later. They didn't do that. Now, there are some economists who say maybe that is the right thing to do. We still have inflation at 6%. But the Fed is in a mess right now. And I think that is really a pretty big story. They were obviously late reacting to inflation. They may have contributed to inflation in the first place with massive amounts of monetary easing in 2020 and 21. And now they're just kind of sticking their fingers in their ears about the banking crisis and saying, it's all about inflation. I don't know. We'll obviously find out in a few months, but this is a very nervy week for the Fed.
But could this potentially not be good for Biden, but give Biden almost a scapegoat here, blaming everything that's happening right now on the Fed, saying, hey, this isn't the result of our administration and the policies right now?
Yeah, I mean, in a sort of a reverse logic way, this could actually work out for Biden. Now he said at the beginning of his presidency, I am not going to discuss the Fed. I'm not going to talk at all about monetary policy the way President Trump criticized the Fed all the time when the Fed didn't do what he wanted. So Biden, and he hasn't done that. He has kept his word on that. He has said, I think, literally nothing about what the Fed has been doing. So I don't think you're going to see Biden turn around and say, well, don't blame me. It was the Fed that caused inflation and then reacted too slowly. But the timing, strangely enough, could work in Biden's favor. So if he does run for re-election, as he has indicated he plans to do, what's really going to matter to him about the economy is where it stands about a year from now, or let's say 15 months from now, which is when voters will be making their decisions on who to vote for in 2024. So in that 12 to 15 month period, we could get through the banking crisis. We could get to the recession that some economists think the Fed is causing by raising rates as fast as it is. And then we could actually be in a recovery phase by this time next year. So that assumes that if we have a recession, it's not too deep, it's pretty short, and that we come out of it. But it's possible that by this time next year, the economy is growing, some of this instability is gone. And I think importantly to a lot of voters, it actually feels better than it feels right now, because it does not feel good right now. It feels very unnerving.
If not, Elizabeth Warren may have an opening to challenge Biden from the left, but lots of time between now and then. Rick, thank you. Enjoy the weekend, sir.
Hi, guys. You too.
Coming up, Activision shares trading higher on hopes that Microsoft's $69 billion deal to buy the gaming company is a step closer to clearing some regulatory hurdles. Got the details for you on the other side of the break.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Activision, Blizzard, Express, and Celsius Holdings. Let's start it off with Activision. Shares pushing to the upside today. You can see up just about 6%, a top trender here on Yahoo Finance. Some optimism that maybe we are a step closer to Microsoft closing its deal of its $69 billion agreement to buy the gaming company. Let's talk about exactly why that is. They could potentially be clearing at least one regulatory hurdle. A UK regulator has narrowed the scope of its investigation into the takeover, saying that it's no longer worried about the agreement stifling a console gaming competition. Now, according to the UK's Competition and Markets Authority, Microsoft has financial incentive to make Call of Duty available on PlayStation. Now, the initial concern was that the series could be maybe in the future exclusive to Xbox. While this is good news, we certainly have a ways to go before this takeover gets approval here. The UK regulator still looking into the potential impact on the cloud gaming market. And Ali, the deal is also facing scrutiny here in the US, overseas from European, from EU regulators. Lots of concerns about competition, this becoming a monopoly within this space. So yes, this clears one small hurdle, but there's a lot more out there.
Absolutely. I would say this is a very partial win for Microsoft here, and especially among competitors. The biggest concern centers around Call of Duty and the possibility that this potential deal is going to block that distribution access to that game. Now, Microsoft has already signed distribution agreements with Nvidia, with Nintendo. It still has yet to secure something with Sony, its biggest rival, but EU regulators did say that the investigation should be completed by the end of April. So we will have an answer at that point. But like you said, Shauna, still big concerns around cloud gaming. And according to Bloomberg, there are some pretty big companies like Alphabet, for example, that is very hesitant about this potential deal. So still
Sony
a lot.
as well. Sony is not signed on yet
No.
either. Brad Smith, the vice chair and president, said this adds to consensus to those with access to the current data that this deal creates more competition, not less. I'm with you, though, on your first description. The Biden administration, Lena Khan's FTC, they are fighting everything in that entire area, and I believe they will continue to mount a challenge to fight that acquisition. Don't hold your breath on Lena Khan going away.
I totally
from
agree.
that.
Yeah, so a lot more developments there. And switching gears to my play, that is Express. Shares plummeting today, down about 12% on the heels of disappointing earnings. The retailer missing on both the top and bottom lines, with net sales falling 14% year over year, while comp sales was down 13%. Guidance also came in underestimated, rough, I should say, with the company expecting Q1 comp sales of negative low double digits and a loss per share between 70 and 80 cents as consumers cut back on discretionary spending against the backdrop of inflation. Now remember, Express was a meme stock at one point, but it is now down about 80% on a year-over-year basis. A penny stock. Guys, things just look really rough right now. And I think if you're a retailer in general, you need to execute on a strategy. And right now, Express has just not been able to do that.
They have a strategy. It's cut expenses. This was brutal. And to hear their CEO talk, while we expect the recessionary environment we experienced in the back half of the year to continue, recessionary environment is what they say they experienced. And here's their entire plan. We've identified $40 million on annualized expense savings in early 23, additional cuts. That seems to be the entire plan to turn this ship around. Bleak, to say the least.
Yeah, it certainly is very, very bleak. And you mentioned that drop that we saw in revenue. Comp sales were also off over 10%. They declined 13% during the quarter. And I agree, you're going into the company has been in a very, very challenging position. Consumers are not spending more on these types of things on apparel, at least for right now. So it's going to be an uphill battle here for Express. And I think lots of people are wondering whether or not they're going to be able to execute on this turnaround plan.
Not looking good, man. All right, my play is Celsius Holdings. Shares feeling awfully pumped up today on news that Wedbush named the energy drink a top overall pick. CELH is down 10% this year. But equity analyst Gerald Pasquarelli writes, quote, "We believe the year-to-date pullback creates a compelling entry point for investors looking for exposure to the," and here's the best part, "most disruptive and fastest growing company in all of CPG." Wedbush naming Celsius to its best ideas list and rated them as their top overall pick. In August of last year, PepsiCo invested $550 million in the energy drink. In the process, they became the preferred global distributor. In the category, though, Red Bull has the big share, 37%, Monster 35%, Celsius 5.6%, but they boast the strongest sales growth over the last 12 weeks at 141%. Wedbush has a price target of $115, implying 27% upside. This is a big opportunity, says Wedbush, and it's also the reason I am getting through this show. I'm a big fan of the drinks, drink a lot of them. This is the guava. Yeah, I just find them less crash than the others and less junk in them.
People that drink them love them. I would say the following is almost like a cult-like following. Once you start buying them, I've noticed people tend to consume a lot of them. And Dave, I didn't know that you were one of those people, but when we talk about the growth of this company, it is amazing. You mentioned the revenue growth that we've seen this year. 2022 was up over 100% from 2021 sales. So this upward, massive, quick trajectory that the company is on, obviously it's a huge win here so far for Pepsi. And Wedbush isn't the only name out there that really likes Celsius. Bernstein was out with a note on Pepsi, naming Celsius as one of the reasons to be positive here on that larger play.
I think how quickly this brand has been able to gain traction and recognition has just been insane to watch. And this is a very competitive market. You're going up against some legacy brands. Exactly.
Lack of a better term.
And you know, like, I agree with you, Shauna, that the people that enjoy Celsius are hardcore about it. And I think notes like this really help investors try and make that decision when you're analyzing this market where there's a lot of options.
Your point's a good one, Ali, because not just big companies, but they came into a saturated space. And I think everyone's consensus was, why would you get in this market? It's already oversaturated. Yeah, they didn't listen. They came right in. I would like to talk to their CEO perhaps next week. They rely heavily on TikTok. They have grown exponentially on TikTok. Check out the hashtag. I would be curious how they'd be impacted by a potential ban.
Is that your favorite flavor?
I don't know. I like about 4 or 5 of them.
All right, I gotta try it. People love it.
Yes, it is. I think guava probably is. You made me really think
now
about
it is.
that.
I'm making you choose. All right. Well, coming in next, we will speak to Evercore's Mark Mahaney, on which social media apps could benefit the most from a potential TikTok ban. We'll be right back. TikTok CEO shows the Chu's testimony before Congress, casting a cloud over the future of his social media platform here in the U.S. and perhaps leaving an opening for other U.S. social media companies to regain some of that lost market share. Joining us now, Evercore ISI Senior Managing Director, Head of Internet, Mark Mahaney. Mark, it's great to see you here. So first, just your reaction to what we heard and what we saw play out on the Hill yesterday, a number of very fiery exchanges, and we didn't get a heck of a lot of information from Show.
Well, I think the big takeaway is that there's a deeply bipartisan opposition to TikTok. So that means that this is likely to be an overhang. There's not going to be any relief here for TikTok for at least the next 2 years. I don't know whether TikTok gets banned, but if we're honest about it, a year ago we would have said the chance of a TikTok ban would have been low single-digit percent. I'm not sure it's over 50%, but it's materially higher than it was a year ago. And this is very different than the hearings that we've watched in the past, when the heads of Meta or Facebook, Twitter, or Google, Amazon, Apple were brought up. This was a national security hearing. At least that's the tone of most of the pushback on the company, and that's a very different dynamic. And given where U.S.-Chinese relations are today, that's not going to get resolved anytime soon. So, I think we should all assume that there's a distinct possibility, maybe not a probability, but a distinct possibility, 30-40% chance that TikTok actually gets banned, and that is going to create opportunities, no question about it, for names like Google, Meta, and Snap.
Yeah, it's interesting. You say some of this was national security, Mark, but a lot of it could have been applied to Meta, to Google, to, frankly, Amazon. I mean, it was a strange hearing in that regard, that take out China, and many of these companies are similar. If you were to focus on a few of those companies, who do you think has the biggest upside if a ban goes in place? Is it Meta through Reels? Is it Alphabet through YouTube Shorts? Or maybe is it Snap, a bit of an outsider?
Look, I may be wrong when I say this, but I think it's very different than those other companies. The concern in the past was that maybe Facebook, well, it's true, was manipulated by a foreign government agency. That was Russia in the 2016 elections. Whether it was material or not, leave that aside. There was clearly an attempt by international actors to manipulate U.S. audiences through social media. The concern that came up right in yesterday's market was this would be an asset that could potentially be influenced by the Chinese Communist Party to influence the U.S. and maybe to gather info, but really to influence the U.S. because we've seen it before. Yeah. Not by the Chinese, but probably by the Chinese government. So that fundamentally different than what you had with other companies. And I know there are other social health issues. My pitch has always been, I thought those were way overstated and they could apply to a lot of media, not just digital media, but whatever. That's the past. What we do know is if you look at, and TikTok, as a technology analyst that focuses on innovation, I have a lot of respect for TikTok. It came out with something that was highly entertaining. You wouldn't have 150 million Americans using it if it wasn't. Well, what's going to happen is they've been taking traffic and time away, particularly from YouTube and particularly from Instagram. So the extent that TikTok gets its influence reduced, maybe gets its footprint in the U.S. Eliminated, that clearly benefits those companies. So Google benefits and Meta does too. And in a small way, I think Snap does too.
Mark, what about your checks that you've been doing with ad spend and where advertisers are spending? Have we seen a shift at all away from TikTok, given the uncertainty, given the fact that it could be banned, and towards some of the other players here in the U.S.?
No, I don't think we have. I mean, I haven't picked it up in checks yet. It's a logical question. So that's what I've been asking marketers and agencies and advertisers, over the last 3 to 6 months. I haven't seen signs of it, but it could happen. I mean, I think we all remember the pull. We had a temporary pullback from Facebook advertising. There was I forget what it was called, quit Facebook, on the marketer side too. So I think you would have, if it gets more controversial, you'll have CMOs having to respond to their CEOs and to the board saying, why are we advertising on TikTok? Not only for social health issues, but this has now become, taboo in Washington, D.C. So I could see how that would happen, but I've not yet seen that in the checks that we've done. I think it's a probability, though, that happens. It's a greater probability that happens. Advertisers feel the need to pull back a little bit from TikTok because of the political pressure that asset is likely to face, and it's not going to leave anytime soon.
One of the media stories you're certainly following this week is the rise of Netflix in the last couple of days. Not sure exactly what the catalyst was, but as you look now, up almost 10% this week, perhaps on the new tier they've added. What do you make of this bump the last week, and what's your outlook for Netflix given the new tier?
Netflix is one of our top picks for the year. Our top picks are Meta, Uber, and Netflix. Netflix offers, I think, the biggest product catalyst out there, across maybe all of media, but certainly across all of consumer media. They're introducing a brand new plan, basic with ads, or they started introducing it late last year. And this solves the problem that Netflix created for itself with all those price increases over the years. They painted themselves into a premium price corner. So now they come out with a lower priced offering. They cut their price by 30%, roughly $9.99 to $6.99. But then on top of that, they can actually increase their ARPU, their revenue per user, because they're layering in advertising revenue. I mean, you never see this in business history, lowering prices by 30%, but raising ARPU. Beautiful. So I think that's the real catalyst. All this volatility that we've had on Netflix, I don't think it's had to do with that. In the last kind of month or so, we gave back all of the gains, or most of the gains from the print, from the last earning print. I think what's happened is this debate about the password sharing crackdown and whether that's going to lead to a spike in churn. And I think the answer is it does lead to a spike in churn, but that's the first order impact. The second order impact, and why I liked buying it on this pullback, and I still like it right here, is that it's also going to lead to a bump up or an increase in number of new subscribers and an increase in ARPU overall, because there are going to be people like me who are going to be willing to pay extra money for my two kids, two of my sons in college and another child over in boarding school. I'm going to pay for them. So Netflix is going to get more money from me. I wish I could still freely share my password, but since they're no longer going to allow it, I'm not going to cancel Netflix. I'm just going to pay a little bit more, and then I'm going to hope that my sons get some income and pay for themselves.
Don't hold your breath, Mark.
Might be a few years for that, Mark. Yeah, I mean, certainly we have seen some momentum here in Netflix, the stock up just over 11%. You also mentioned Uber as being one of your top plays, and certainly we have seen some momentum in shares since the start of the year. What's the catalyst there to keep that move to the upside?
I'm stumped. I'm not sure the answer to that. I know you say the stock's up year to date, and it is like 20%. But if you look at the chart, it just can't seem to break out of that, mid 30s range, that $34, $35 range. And I sort of feel like, what the heck's going on here? I really like this stock, but when people and investors and clients ask me, well, what's the catalyst? I'm increasingly a little bit stumped. They're generating consistent premium revenue growth, 20%. They finally started generating positive free cash flow. The amount is building each quarter. We just removed two of these regulatory overhangs, Prop 22 out here where I am in California, and then back in New York, the minimum wage issue with delivery workers. So if you had told me all of this at the beginning of the year, I wouldn't have said it's up 20. I would have said the stock's at $40. So whatever that would have been, it would have been up 70, 80, 90%, but it isn't. So I'm a little stumped by it. I wish I had a better answer for why it isn't. I'm going to stick with the fundamentals. You're going to have a lot of free cash flow next year. I just don't think this thing is going to stay with a 6%, 7% free cash flow yield where it is now. I think the stock is going to materially outperform. I just thought it would do so earlier. So I'm a little bit stumped, but I'm sticking with it on fundamental and on valuation grounds.
All right, Mark Mahaney from Evercore, good to see you. Let us know if you find a way to get those kids to chip in, all right? We can use some tips.
All right.
Thank you, sir. All right, T-minus 25 days until tax day, and there are meaningful changes to keep in mind before retirees finish filing. Time now to talk about getting retirement ready with Aaron Ulrich, Family Wealth Strategies Financial Advisor. Good to see you, sir. This segment brought to you by E-Trade. What should retirees keep in mind this year before filing?
Well, before filing, we're talking to people about the changes that are coming down the pike. So their Secure Act 2.0 passed late last year. It was a part of a bigger bill. And there's some parts of that go into effect for when they file this year. There are other parts that go into effect for tax year 2023. So not going to go into effect until they file in 2024. And so it's creating a lot of confusion. So we're working through it with them on what they need to know, what they can forget from old rules, and helping them understand that kind of the new normal is changing tax code. It's here. I think it's going to continue through our retirees, through their retirement. I think you're going to see the political influence on the changing tax code, and that's affecting a lot of our clients.
Well, when it comes to what people need to know, retirees need to know when they're filing this year, you mentioned Secure Act 2.0. Some of those changes go into effect this year. What are they, and what should people be doing about it?
Yeah, so the big stuff there is that the the required minimum distribution age has been raised. Okay, so forever that was 70 and a half, which was confusing. I don't know who at the IRS decided that half was a good idea, but so that changed. And so it's now they had raised it to 72. And then beginning this year, that went to 73. So that's the big one that came through on that. Additionally, the penalty. So if you mess up your required minimum distribution, so you have to take a little percentage out of that bucket. If you mess that up, in the past, it was very punitive, a 50% penalty if you made a mistake with that. Well, they've done the right thing, in my opinion, and they've backed off that penalty. So they've reduced it. I think in a lot of cases, it might be even 25. And they've even expanded the ways that you can kind of get a get out of jail free card. And if you fix the mistake quickly, they're not going to enforce that penalty. So some positive changes there.
Aaron, I would imagine you have clients every day for the last couple of weeks calling you and saying, what is going on with the banks? What does this mean for my retirement? What do you tell them?
Yeah, and we do. And there have been people calling. We get emails. What's going on with the banks? The first step that I want to take with folks is let's take a reset here and figure out what is the real risk to you, okay? And so we want to use that as an opportunity to understand what is the FDIC limits? How does that work? Is it the same for a single account as it is for a jointly held account? Do those FDIC insurance limits automatically double? Additionally, we want to take a look at their overall portfolio and start understanding where they're at, that the risk you're taking of being in a small or a regional bank, it's just not the same here in Louisville, Kentucky, as it might be for Silicon Valley Bank, and help them understand what the regulations are, why it's important to think about those things. Bank regulations, I mean, talk about an exciting topic, right? So we want to help them understand how those regulations came to be so they can maybe make a better informed decision on who to vote for, possibly, if that's an important thing to them. But mostly we're trying to help them understand that, yeah, your money's safe. I'm not going down to my bank to pull any money out. I don't think you should either, but you should absolutely understand what happened and what are the risks involved with your bank.
Very, very important time for everyone to understand what's going on. Aaron Ulrich, great stuff. Thank you. Well, coming up, we are counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live.
we're just minutes away from the closing bell. That's time to bring in Yahoo Finance's Jared Blickery to break down the market action. What are we seeing on a Friday, my friend?
Looking at some wins today and for the week as well. Go through the list here. Dow up by 1/3%, S&P 500 a little more. For the week, the Dow putting in gains of about 1%, and the Nasdaq just a little bit better, 1.5%. Pretty good considering all the volatility that we had this week, including a potentially considered hawkish Powell on Wednesday. Now, you take a look at what's happened today in the sector action. Utilities, real estate staples, and healthcare. That's a pretty defensive setup right there. Consumer discretionary financials, only the ones in the red right now. But let's take a look at the 5-day view. What happened this week? Communication services, that houses all those TikTok competitors. I think that's the story there. That's up 3%. Then materials and tech. By the way, both tech and communication services benefiting from the drop in interest rates. Those are the outperformers. Real estate, utilities leaders today are the underperformers for the week. So a little bit of a change up there. And here's the Nasdaq Composite, or the Nasdaq 100 for the week. You can see the mega caps looking at some decent gains there, except for Amazon. Apple up over 3%. So is Nvidia and Alphabet. Meta up 5%. So is Tesla. By the way, here's what happened today. But of course, we've been focusing on the banks. And let me just turn to them. We got about 30 seconds left. Going to do a deeper dive in the next hour here. But you can see Deutsche Bank down 3%. Definitely pairing losses. It was looking pretty grim earlier today, but only down about 3% right now. We'll be checking in on them next week, and especially Monday, to see if there's contagion that falls out over the weekend. But here are the regional banks today. You can see a lot of dark green on your screen. And heading into that bell, I'll just leave you with this.
And that wraps up today's trading day and really the trading week. This market check sponsored by TC Trade. All three of the major averages holding on to gains. We have the Dow closing up 131 points, S&P up just about 0.5%, the Nasdaq up about 0.3%. Taking a look at some of the outperformers over the last 5 days, communication services, materials, technology, among the outperformers there, utilities and real estate. The laggards of this past week, financials, that certainly has been the big story. Started the week talking about Credit Suisse and UBS, ending the week a little bit worry out there about Deutsche Bank and exactly what the future looks like for that German bank. Shares closing off just about 3% today. And Jared mentioned the regionals. We saw some relief there. Well, one of the outperformers of this week, Manchester United, is spiking again. Shares closing up nearly 10% over the last 5 days. Josh Schaefer is here with a breakdown on what has certainly been a wild ride here for Manchester United, Josh.
It has, Shauna. So here's a look at Manchester United over the last 5 days. You can see it up about 8%. But I want to take a longer term look here. And when you go 6 months, you can see when the speculation of the sale of Manchester United started. Of course, that was November 22nd. The Glazer family said they were, quote, exploring strategic alternatives. Stock nearly doubled over 3 days here, and really you saw volume spike too, which was pretty interesting, guys. You had this stock normally trading about 500,000 times per day. That went up to 5 million, 16 million, 35 million over that 3-day period. Then you see a couple other interesting points here over time. December 8th, that's when Manchester United had their first earnings release since the announcement of the sale, and people started taking a closer look at what this team has really been up to in the club. Shares fell about 10%. It was their third straight quarter reporting a loss per share. But then in February is when we've hit spikes again here. So February 8th, the Daily Mail reports there's Qatari interest. The stock surges up over 10% intraday that day. About a week later, February 16th, you see another big turn. This was when the Telegraph reported that Saudi Arabia may be interested in getting involved in Man U. And then, as recently as March 10th, we saw Elliott Management was reported to be over in England talking to Manchester United, potentially being willing to participate in funding, not necessarily buying the team, but maybe helping financing. Manchester United took another big jump there. But then when you look at this week, there's been an interesting development coming out yesterday that maybe the Glazers don't actually want to sell, Dave, and maybe they'd just be interested in getting a little bit of financing, a little bit of capital, but holding on to the team. And so now you've seen a little bit of a sell-off there. So interesting to see who's involved, how much it would sell for. The market cap of Manchester United, I should mention, about $4.2 billion right now. So you can bet investors have been basically speculating, well, if it sells for $6 billion, like some say, maybe they can make a little bit money on that trade.
Yeah, 6, maybe even 7 billion. Josh Schaefer, excellent work there. The bidding war for Manchester United is heating up as potential frontrunners begin to emerge. British billionaire Sir Jim Ratcliffe, who said this week he submitted a second bid for the club, one of fewer than 5 reported bids, said to also include a Qatari and potentially a Finnish group as well, while, as Josh Schaefer mentioned, Elliott Management has reportedly made an offer to buy a minority stake in the club. Joining us now for more on Man U is Steve Olenek, Mint's Chair of Sports and Entertainment. Good to see you, sir.
Great to be here.
Been a while. So is this going to be a new record purchase price for a pro franchise, or is it going to be something else? And who gets this team?
This is what I think. I think the bankers are doing a great job. Drive up the price, right? Drive up the price, bring in the credit, pull off some chips off to the table, then reinvest into the team. So maybe not actually have a sale, but actually rebuild into the infrastructure, the stadium, the training facility. So I don't think that they're potentially going to sell this. I think they're just going to drive up the price.
Elliott Management, perhaps.
Correct.
How does, though, if they do sell this, when we're talking about a sports team being sold in this type of scenario, since it is a publicly traded company, how does that complicate it? Or what does Manchester United, the Glazers, need to keep in mind in this type of scenario?
Well, great question. First and foremost, they have to buy them out, right? Is it going to be an all-cash deal? Is there going to be a debt element to it? What does the actual deal dynamics look like? In terms of the UK, you need to have all that money up front, right? So you can't just say, oh, we're going to think about getting this financed. You actually have to have the money there. So I think this is a very complicated deal. Using the public markets per se, that once again, bring up a financing partner, drive up the price, try to pull some money out, recapitalize it, and redivide and kind of restore where you're going to go with it.
With the, sorry, Josh, with the massive escalation of sports values, will we see more teams tap public markets?
Yeah, I mean, look at it. I mean, you see the Atlanta Braves. Look at that. Look at Juventus. I think that's going to be the ongoing theme in terms of doing this. I think what you're going to start to see is sports as an alternative asset class. So I think a lot of people are going to want to see and actually participate in these types of deals. However, as we all know, there's very few ready, available, willing buyers that can actually write that check, especially from a cash perspective.
Why is it advantageous for the franchises to be public in this case, or is it not advantageous when it comes to a sale?
Yeah, there's not really so much whether it's advantageous or not. I think it's to raise the financing profile. So to see like what or how they're going to actually sell off some of the actual like shares to raise the price, right? In terms of getting some liquidity back. So I don't necessarily know if it's a public deal per se, whether that's going to drive it. It's just whether they can actually raise the money or not.
See, we have just seen a massive explosion in the values of many of these teams. A lot of these sports investments have turned out to be a total home run for those who have bought in. Is that trend, is that something that's going to stay intact, or how long until we start to see maybe some of these values come back a bit?
Well, I mean, as long as the media deal and the media rights deals keep going up further and further and further, I think what we're going to see is these asset values keep going up, right? Until there's some type of stabilization. I think the ready, available, willing buyer, there's going to be always a lot of people that want to have these as a sexy asset and a vanity asset to hold. If you can afford it.
Yeah.
Well, I'm curious what you've heard demand-wise then, as this has sort of picked up. I feel like we've been talking about a lot more in the last few years. Maybe Arctos has become a very public-facing part of that, and some of the stories that have come out of the funding they're doing. Has it become a lot more popular just as far as calls you're getting and hearing from clients?
Yeah, I mean, I actually have multiple deals going right now. So, I mean, I'm seeing the demand uptick quite frequently in terms of like people wanting to get in, and then also seeing people to try to like kick the tires a little bit in terms of what they can and cannot get.
Typically, a franchise is held for 30 or so years.
Right.
So why would this be attractive to private equity when there's no real exit?
Well, there could be an exit, but you could also look at it as a potential trade. Buy it now, have the growth go up with the media, and then try to sell it off. So it all kind of depends in terms of what your risk profile is, how long you're willing to hold, and what exactly percentage you own as well.
God, I wonder if we'll see a $10 billion team sold in the next 5 to 10 years. Seems
unbelievable.
So much
yeah,
money.
I mean,
do you think it's a bubble? Some people call it a bubble, right? Maybe it just is getting too big, and is $10 billion just too much for someone to pay, right, for a team?
As long as there's someone out there to write that check, there's a deal to be had.
as long as Jeff Bezos wants a team, that remains a possibility.
Yeah.
Steve Olenek, good to see you, sir. Thanks so much. Josh Schaefer, thank you as well. Ahead, tech giant NVIDIA is making its push into AI. CEO Jensen Huang filled us in on his company's game plan. Stay tuned to hear what he had to say about the future of artificial intelligence.
NVIDIA ramping up its push into artificial intelligence, the company announcing new plans at the annual GTC Developer Conference. Yahoo Finance's Julie Hyman and Dan Halley spoke with CEO Jensen Huang earlier this week. And this is what he had to say about that progress in AI.
This is the first time that AI has reached an inflection point such that this AI capability is so easy to use. Almost anybody can program it. You can program it to develop all kinds of interesting applications, and it's so accessible. And so when you think about a new computing platform, whether it's the PC, the internet, the mobile cloud revolution, every generation, the number of applications, the number of programmers, and the reach of that platform increased. And this is absolutely the case. You could see this with ChatGPT, the AI heard around the world. In just a couple of months, it reached 100 million users. And the number of startups, the number of applications that you're now starting to see on generative AI is just growing extraordinarily. So this is definitely the beginning of a new computing platform.
Jensen, I want to ask you about the generative AI aspect. We saw a lot of that kind of in your keynote, the talking about generative AI. And NVIDIA made some announcements, partnerships with Adobe, for instance. Where does generative AI, though, fit into your broader portfolio when it comes to AI?
Well, first of all, we're a full stack computing platform. We start out with the AI infrastructure, and this GTC, we announced a massive deployment of Hopper generation. AI supercomputers are being deployed all over the world. But very importantly, this is also the first generation where AI is moving out of the laboratories, out of research, and into industrial operations. And so instead of just a supercomputer for training, this is going to be now an AI factory for every industry and company to produce intelligence. Whereas companies in the past would build, factories for all kinds of different products and different things. In the future, there will be factories that are created for every company so that they can produce intelligence. And so this is really an extension, a major extension of how AI is going to be used. Generative AI is behind that. The second thing that we do is, of course, the operating system and the software stack layer of AI. We have two platforms for that. One is called NVIDIA AI. The other one's called NVIDIA Omniverse. NVIDIA AI is where intelligence is created. Omniverse is where intelligence simulated and tested. One is a virtual intelligence. The other one's a virtual world. And these two platforms we have now put into the cloud. And so in doing so, we're partnering with the world's CSPs to take the best of NVIDIA, the NVIDIA AI DGX supercomputer, the two NVIDIA platforms, NVIDIA AI and NVIDIA Omniverse, and we're now making it available as cloud services, all hosted inside the world's leading CSPs. And so in partnership with the CSPs, we're going to combine the best of NVIDIA and the best of the leading CSPs, and we're going to bring AI to the world as quickly as possible.
And Jensen, you're good at sort of laying out this grand vision, right, for those cloud service providers, for those clients. We're looking at some cool pictures, too, of how this is all going into play. You talked to us a lot last year at this time about the Omniverse. So I have two questions for you. First of all, to sort of make it concrete for those of us who are not steeped in this stuff all the time, what are some examples of this being put into practice? And how is your Omniverse different now than it was last year? Is it that being put into the cloud aspect?
Well, so far, Omniverse has only been an on-prem enterprise solution. And the fact of the matter is, this stack, this supercomputing stack, artificial intelligence stack, is really complicated. And the answer is to put that up in the cloud, for us to fully manage it, host it, manage it. We host it from Azure and benefit from all of the security and all the industrial certification, all the storage capability, and all of their enterprise APIs, and all of their productivity APIs. And they've also done a lot of work with industrial metaverse. And so all of that work is now going to be tied into Omniverse, and we can take this to the world. What Omniverse is to help companies that build physical things to do everything digitally first. And so whether you're building cars or making, devices or phones or, building plants or factories, logistics warehouse or designing large buildings or even designing cities. Today, you have to do things kind of on paper, and then you try it in the physical world. And as you're building it and you make mistakes, you do change orders. All of that doesn't have to happen. You should be able to do that completely in digital. And when you do it in digital, all of the organizations around your company, and these, the car industry has 14 million employees, and it takes all of those employees working together to build a car and manufacture it around the world. And so now these 14 million employees could have a digital platform that connects digital and physical, and for them to be able to design the cars, design the factories, all in Omniverse, use generative AI to test it, to help populate it, to optimize it. And then before they do that, they virtually assemble it before they break ground and build a factory in reality. In doing so, the number of change orders will reduce, the time to market will reduce, any plant opening delays would reduce. For an industry as large as the auto industry, which is $3 trillion large, all of this is going to translate to hundreds of billions of dollars of savings. So this is a very, very big deal that we can help the physical industry of the world become digital for the very first time.
All right, well, coming up, we will revisit some of the biggest stories of the week, including the Fed's decision to raise rates amid the banking crisis. Stick around.
All right, time now to break down the biggest business stories of the week with a vibe check. The good, the bad, and the ugly. Yahoo Finance's Ali Canal is here with us. Up first, we have the TikTok hearing. And I don't know if good, bad, or ugly fits here. Atrocious, appalling might be more fitting. I don't think TikTok did anything to assuage the fears of national security concerns, the fear that Data could be compromised by the Communist Party and weaponized if they need it. I don't think anything was done to calm the fears of congressmen on the right or the left about their constituents, nor about our national security. And most of all, I don't think any parent like myself or anyone else out there watching can sleep at night now knowing how compromised their data could be and how much harmful content is on the platform and remains on there today. Then again, is that any different than any other social media platform? No, probably not, save for the Chinese government aspect of this. Ultimately, though, you talk to every content creator out there and all the businesses who also operate on the platform, they'll tell you they don't care. They were born in an era of which our data is just not secure. They're willing to give it away. And ultimately, do I think a ban happens? No chance, zero. Why? I hate to get grim, but I would say Sandy Hook is why. Nothing has horrified parents and legislators more than the shooting in Newtown, Connecticut years ago. And what happened? Nothing. Nada. Nothing happened at all. How about Frances Haugen? Remember the Facebook whistleblower testified before Congress that Facebook was knowingly putting on harmful content when it comes to eating disorders and young girls suffering from depression. What happened? You know what happened. Nothing did and nothing will now. What happens? Congress raises a stink, they raise some money, elections come, and issues go, guys. That's what will happen here. I'm sorry to say it. I know there's a lot of momentum. I know we have on people like the FCC commissioner who talk about a ban. I would give it 5 to 10% chance of happening. Oh, he said north of 50. It ain't gonna happen. Congress moves on to another shiny object, and they will here.
I think Congress will move on, but I think there is certainly a lot of emphasis on this and on this moment. And I also think that it's something that Wall Street is taking notice of. We certainly have seen the reaction in some of TikTok's competitors here in the U.S. So I think there is at least more thought going in to the possibility of a ban. Do I think it's going to happen? Probably not, given the fact that 150 million Americans use TikTok, but I totally agree with your vibe check. It was terrible. It was very alarming. It raised a heck of a lot of questions, and we heard that from a number of lawmakers saying that after this hearing, they actually got more questions. They had more questions than they got answers to. Exactly the direct impact here on data, what it means for national security concerns, but also the social impact. And I think that's something that got a lot of people's attention.
But the social aspect, you could say that about Facebook, about Reels, about Snap, about Twitter, about every social media platform.
Yeah, and that's what I was going to say. I really think it's this China component that is causing this platform for a lot more scrutiny. But I got to say, this is a bipartisan issue. You want to get Republicans and Democrats on the same side. You just got to give them TikTok. And for me personally, I'm a true millennial. I just go on the Instagram Reels and I see the old TikToks back in the day. I don't frequent the app. I have the app, but I was concerned a little bit about privacy. But as we've kept saying, that really is something that we've seen across all of social media. It's a systemic problem.
Yeah, but it was I would say terrible would be the vibe check of TikTok's hearings. All right, let's also talk about the banking crisis. So lots of developments going on this week. We started the week talking about Credit Suisse and UBS, the rescue deal there from UBS coming in and agreeing to buy up at Credit Suisse. That helped assuage some of the fears out there, but certainly the volatility continued throughout the regional, some of the risk there over the fact that investors continued to withdraw their deposits. My vibe check of the banking sector right now, it's not terrible. I would say it's bad. And I say it's bad because there's still a lot of hope that maybe we are going to be able to avoid something getting even worse within the banking sector. Yes, there is certainly a lot of stress. Yes, there are certainly a lot of questions about what needs to happen to the future of insured deposits. Lots of questions about whether or not that should actually be expanded. We heard Treasury Secretary Janet Yellen. She kind of poured cold water on it, saying that right now the Treasury is not considering any sort of expanding the deposit insurance there, which was a blow, which obviously did have an impact here on the broader markets. But at least for right now, that broad contagion that we were so worried about going back 2.5 weeks when Silicon Valley Bank failed, that scenario, that talk has not necessarily gotten worse, which I think we should all be breathing a little bit of a sigh of relief right now.
And we have heard upbeat sentiment from Fed officials. We just heard from James Bullard, St. Louis Fed president. He said he's optimistic that the stress in the banking system is going to abate. This is a quote when he spoke earlier today. I would put 80% of probability on the case where financial stress abates. If it doesn't abate, that's a completely different world where financial stress gets more intense, and I would be willing to react to that. So that's a very bold, optimistic statement from a Fed official. You mentioned Janet Yellen. She actually held a closed-door meeting today with members of the Financial Stability Oversight Council to really calm the jitters in the banking sector. So this is a priority right now among regulators.
So are you agreeing with the bad vibe, or where are you at on that?
I would probably agree with the bad vibe. I don't think
Give me your disagreement, Dave. It wouldn't be a...
Well, no, mine is slightly closer to good, and that's because everyone we talk to about this story says this is almost all emotional right now. Yes, it is a game of whack-a-mole. Some other bank will undoubtedly pop up, as Deutsche Bank did today, but most of it is overly emotional reaction. Ultimately, the one question I do have is about lending conditions here in the United States and how they're impacted, how much harder it is to get a home loan, how much it is to get a car loan, startups, how much they're impacted, and then will that impact bank earnings in Q1 and start to have a little bit of a snowball effect?
Yeah, and also I think, and the big story to keep in mind heading into the weekend, heading into next week is, of course, Deutsche Bank. We saw the stock sell off earlier in the day, closed down, just about 3%. Citi saying that reaction was a bit overdone all over the credit default swaps, a rise in insurance prices there. So I think for right now, we're going to be okay, but I'm sticking with bad.
Yeah, analysts at DB, we're pretty calm, I would say, considering the news. And last up, we have Chairman Jerome Powell and the Fed's 0.25% rate hike on Wednesday. Now, guys, my vibe is neutral. Not bad, not good, because you could really argue both sides here. On the one hand, that 25 basis point hike was widely expected. We know markets like certainty. There were really no surprises there. But on the other hand, we are in the midst of this banking crisis. Some economists believed that the Fed should have paused rates to just take a wait and see approach to see how this all played out. But really, that's uncertain given this macro environment. And for me, what pushes my vibe slightly more positive is the fact that the Fed finally setting the stage for ending its aggressive rate hiking cycle, doing away with language like ongoing rate increases in interest rates, saying instead, quote, the committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. But again, hence the neutral rating, that's not so great news considering we still have inflation that is quite hot, 6% right now, although we did see signs of cooling in February. Because of that, it's likely that we're going to see more rate hikes. The Fed did anticipate this when they released their dot plot projections. They think that inflation will continue to rise and that interest rates will peak at 5.1% this year. St. Louis Fed President James Bullard said that he expects 5.6 to 5%. So a lot of moving parts here, but I think considering everything that has happened so far over the past several weeks, it could have been much, much worse.
Agree. I would again, like Shauna's, tilt a little bit more towards the good, simply because I think he's done a very good job. Even though they started this fire, I think they're doing a pretty good job of putting it out. I am concerned about their lack of supervision and their lack of foresight on what was happening at SVB. I thought that was a pretty poor job by the Fed, Shauna.
Yeah, that was a poor job by the Fed, but I think Chair Powell did an excellent job at the hearing, really talked about both sides of the story here, made a strong case for why the bank remained committed to getting inflation under control, why the central bank was raising rates by another 25 basis points. And he did offer some reassuring comments about the stress that we're seeing in the banking sector, that he still sees it safe and sound right now. So I think he addressed both sides very well. He has a tough job. Very, very tough job. I don't think many people will be envious of it right now.
You can't please anyone, investors especially, and that's why I think the trading has been so volatile.
Yeah. Not a job I'd want. Ali Canal, thank you. Have a great weekend.
You too.
It was indeed a busy week for Fed Chair Jerome Powell as the central bank made a move to hike rates by another 25 basis points on Wednesday. The Fed chair giving some guidance on where things can go from here. Let's listen.
It's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time. And in principle, if that means that monetary policy may have less work to do. We simply don't know.
Is this recent chaos a boon in the battle against inflation? And what will happen to the economy as Powell continues his fight? To discuss where we go from here, let's bring in Executive Director of the Watchdog Writers Group at the University of Missouri School of Journalism, Christopher Leonard. Christopher, good to see you, sir. So given the banking crisis, given the ongoing hot inflation in the top labor market, how do you feel Jerome Powell did this week?
Well, I mean, as you pointed out earlier, Jerome Powell is in a position that none of us would want to be in. He has an unenviable job. The Fed is in a tight position. And last year, I don't think it's fair to say that they raised interest rates. What happened last year was an interest rate shock, going from 1% to 5%. And that is really the root cause of this volatility in the banking sector that we're seeing right now. And Jay Powell knows that really well. He's been talking about this for years inside the Federal Reserve, about the sort of shock effect that you can have from interest rate hikes like this after a decade of ultra low interest rates coupled with quantitative easing. So the position he's in is trying not to essentially make the bank sector implode while fighting inflation. And I think we're in a state of real risk, because what Jay Powell is telegraphing, and what the entire FOMC is telegraphing, is that we are going to see rates at or around 5% for the rest of 2023. And that is going to have significant, knock-on effects in financial markets. And, obviously, to state the obvious, the real question here is, where does inflation go? The Fed said yesterday they're seeing an elevated risk of inflation. That's not great language. They're going to have to keep rates high to get down to that target of 2%.
How much more aggressive than, Chris, do you think the Fed might potentially get if they're still looking for that 2% inflation number?
Not much more aggressive than where they are right now. It seems like they're expecting rates to sort of flatten out from here at 5%. But again, in terms of the whole vibe check, I'm sorry to say, I'm on the ugly side. I'm in the red right now, because we haven't seen 5% interest rates since 2007, since before the global financial crisis. This is a major change. And the key is not whether or not the Fed is going to hike rates further. I don't think that there's much chance of that. But the big question is, what is the world going to look like throughout this year if a 5% interest rate is maintained? That's the question. Are they going to keep the rate at 5 throughout 2023? The signal that they're sending is that yes, they are. But we're already seeing a lot of volatility at a 5% rate. And so the question is, what happens going forward from here?
Of course, the markets are betting that Powell is wrong and that they will begin to cut this year. If the markets are wrong and if Powell's right, what will the economy look like later this year?
I love that you're bringing that up. It is the most bizarre situation. I don't think Jay Powell could be more clear. He had that big statement in August in Jackson Hole where he said there's going to be pain. We are going to fight inflation. He invoked the name of Paul Volcker, the legendary Fed chairman who fought inflation in the 80s, causing a massive recession. And then you've got Wall Street saying, yeah, we don't think so. We think you're going to be cutting rates by this summer. We think you're going to step off the gas pedal in terms of rate hikes when you see the damage that gets done. So this is a conflict, if you will. I think we need to take the Federal Reserve seriously when Jay Powell says, and the so-called dot plot, or the estimates that the FOMC has, shows they're going to stay at 5 throughout 2023. And for the economy, the effects are going to be serious. I mean, I'm not an alarmist by nature, but I've been pretty skeptical in my book about the Fed, The Lords of Easy Money, looking at the super easy money policies over the last decade. It is hard to envision a world where we stay at 5% for the rest of 2023 without having massive downward adjustments in asset markets.
So, Chris, what more then does that look like? We talk about a recession. It sounds like you think that's a sure thing. How deep of a recession could we potentially be looking at?
I mean, great question. So when rates are this high, you see destabilization and drops in markets from corporate bonds to stocks. Okay, we're seeing all of that. Having a bank like Silicon Valley Bank go under virtually overnight because of an effect that is directly tied to the rate hikes. That's what wiped out the value of Silicon Valley's treasury bonds. And incidentally, the entire banking industry, when you look across it, there's about $600 billion in unrealized losses on the bonds on their balance sheets. But those losses get realized if the banks have to sell the bonds. This is why we're seeing this increased anxiety around the value of banks. What I'm getting at here is we don't know. We don't know how deep that recession might be, because whatever the old Warren Buffett statement about the tide going out is when you see, who hasn't been wearing a swimsuit. We're discovering that now. And I just can't overstate, March isn't even over. We're the first quarter into a year of having these elevated high rates. And the severity of the recession or the downturn will depend on how severe the banking crises are. And the crises in the sort of credit risk and this other stuff like corporate junk debt, massive market, highly sensitive to higher rates as these companies are trying to roll over their bonds in a much higher interest rate environment. These things are going to become more and more apparent the longer rates are elevated.
Man, this is a conversation we would really love to continue. Unfortunately, we're out of time. Christopher Leonard from the terrific School of Journalism at Mizzou. Good to see you, sir. Come back and see us. We'll be right back.
TikTok CEO Shou Chew facing a bipartisan grilling from the House Energy and Commerce Committee on Thursday. We heard a lot of talk about the negative sides of the app and why it should be banned.
TikTok is a weapon by the Chinese Communist Party to spy on you, manipulate what you see, and exploit for future generations.
Providing harmful content directly to children.
Your algorithm can promote suicide, self-harm, and eating disorders. It's also a portal for drug dealers.
This video has been up for 41 days. It is a direct threat to the chairwoman of this committee. I think that is a blatant display of how vulnerable people who use TikTok are.
Your platform should be banned.
Well, despite these risks flagged by lawmakers, TikTok is incredibly popular. How popular? 150 million people use the app in the U.S., and it is certainly a very powerful marketing tool for many small businesses, including our next guest. Joining us now is Carrie Deming, owner of the Dog-Eared Book in New York. Carrie, it's great to see you, and I know you rely on TikTok, or I should say TikTok helps generate a large portion of your sales. What was your reaction to some of the concerns brought up from lawmakers yesterday and what that means for you and your business?
Honestly, watching those hearings, I didn't get to watch the whole thing, but I saw a number of the clips from it afterwards, and it was sort of devastating, their perspective on TikTok. And as a small business owner, it's been massively beneficial. Since I joined TikTok 2 years ago, the growth of my bookstore has been exponential. And if I lose TikTok, that all just goes away overnight. It's kind of a terrifying proposition.
Yeah, the CEO of Barnes & Noble recently told us, Carrie, that TikTok has fueled an explosion in reading as far as his business has seen. We want to tell people a little bit about what you do on TikTok to your 97,000 plus followers. Here's a little example.
So hi, my name is Carrie, and I owned this bookstore, the Dog-Eared Book. Of course I could help pick out some great intro to fantasy books. It's another out-of-control New Book Tuesday. Publishers are not the ones who decide what's stocked in my store. I get to choose that. So I brought our clearance cart back. We're just trying to get $1 a book for some of these. I want to try this too, the fantasy book bracket. This is going to be my first ever Book Talk Lied to Me post. And look, there I am. Second review. Okay, they got the name of my bookstore wrong, but close enough.
Book Talk with more than 45 billion views recently, Carrie. Tell us about the TikTok you know versus the one that was described yesterday and how you utilize it.
I mean, the TikTok I know looks nothing like what they were talking about. I'm on Book Talk. It is the most wholesome corner of, any of the internet. And with Book Talk, we have this amazing community. And people, feel like they know me because I'm in their living room every single day with book recommendations and general book silliness. And I feel like I know them. People are, we're mutuals talking about books. I see the same people in my comment section all the time. And then so many of those people recognize their names on orders, after I'm like, oh, hey, we were just talking. And then they order that book. It's nothing like what they were talking about in those hearings. It's just this happy little cozy place where we talk about books.
Sounds wonderful. And Carrie, I loved your videos and I love the positivity and how upbeat you are about them. And it's no surprise that TikTok is so addicting. When we talk about the content, we talk about the algorithms that TikTok uses. Do you have a presence on other platforms? And what happens if TikTok is banned? Are you going to be able, do you think, to move your following over to those other platforms?
My bookstore's been open for 8 years. And for that whole time, we've been on Facebook and Instagram. And on Instagram, I have like 3,000 followers. On Facebook, I think, 2,700 or something. Or TikTok, I've got 97,000. So, when I do a post on any of the meta platforms, they're, rather ineffectual. Those are very much pay-to-play platforms, which, is a very little business I can't really afford to do. Whereas on TikTok, I just got on there with my goofiness and, found a following. Some of them will come with me to the meta platforms, but obviously not all of them have when you look at the following counts.
How though, Carrie, if at all, are you concerned about the Chinese Communist government having your user data and doing with it whatever they want?
I mean, honestly, I have a smartphone, right? Do you have a smartphone? I have Facebook. All those things are already tracking every single thing I do. I can't imagine that what TikTok is doing with my data is any worse. I mean, when you look at the stats on what Amazon does with people's data, I think it's just as bad and no one seems to care. So, I mean, I'm fine with it. I don't know what they would do with my data. I talk about books. I'm a very boring person.
Well, Carrie, you certainly joined the consensus that we've heard from a number of creators over the last several days, and really simply the fact that many just don't care, at least up until right now, about the access that TikTok has on your data. Carrie, thanks so much. Well, coming up, global banking anxiety rattling European-based Deutsche Bank and Credit Suisse over the past week, but find out why it matters for the U.S. as well. That's all coming up next.
The latest chapter of the ongoing bank saga features issues plaguing European banks. Credit Suisse was rescued by rival Swiss bank UBS amid a collapse, while German-based Deutsche Bank shares plummeted as the cost of insuring the bank's debt against default leapt to multi-year highs. But why does it matter for the U.S.?
Our own Jared Blickery has all the answers for us. Jared, break it all down.
Oh, with that kind of pressure, let's begin here. This is a Eurostock Banks Index, the SX70 as they call it. You can see down 4.5% for the week. Banks are supposed to be boring. That is a very big number. Now, let me show you what's happened. This is our banking heat map in the U.S. and also abroad. And you can see kind of a mixed bag here where a lot of the names on the top shelf here are the tried and true U.S. names, which haven't been affected this week. And then on the bottom, we have Credit Suisse down 57%. Of course, it was bought by UBS, or that's in process. Deutsche Bank down 5.5%. Why does this matter to the U.S.? Because when the banks catch a cold, or is it a sneeze? When the banks sneeze, the rest of the economy, the rest of the sectors, they catch a cold. My point is here, this has the potential to spread into the other areas of the economy. But in the U.S., we're specifically looking at the regional banks. Now, the bigger banks have been ring-fenced by Dodd-Frank, and there have been exceptions to the rule that have been given to some of the regional banks. So we've seen them suffer disproportionately. At the end of the day, it has to do with interest rates mismatch. These regional banks, and even the big ones, are only giving investors 0.5% to 1% in their savings account. Meanwhile, investors have figured out if they go to money market funds, they can get 5%, or treasury bills, they can get 4.5% to 5%. So huge mismatch there. And as long as that continues, we're going to see continued deposit outflows from U.S. banks. Now, the Federal Reserve has backstopped this. They have issued a new or they have created a new facility to help this situation. But by no means could this necessarily contain all of the potential contagion. And in fact, there are a lot of unknowns at this point, and so that's what we're working up against. Now, going forward, the Fed has kind of indicated that they're going on pause here. Now, that could be good for the markets, it could be bad for the markets. We're going to have to see. But in the meantime, we're going to keep our eyes on the banking sector, and especially on those credit default swaps, which we really haven't talked about in 15 years. Those levels have been elevated in certain European banks. We're going to see if that spreads to the US. Let me just show you a couple of charts here, and this kind of illustrates what I've been saying. These are some tweets that I got from Jim Bianco over at Bianco Research earlier this morning. And the first here, let me see if we can pull this up. There we go. This is the Fed's balance sheet. This is reflecting that new facility. Remember, this is the QT effect. This is the Fed winding down its balance sheet. But with the new facility, guess what? Banks are using the emergency lending part. And as long as they're using the emergency lending part, that has a potential to slow down the economy the same way that interest rates do. So financial instability, banking panics have the same effect on the economy, or similar effect as interest rate increases. And that's kind of what Jay Powell and the Fed are banking on right now. So with that, having said that, and having thrown out some confusing terms from the global financial crisis, I'm going to send it back to you guys.
No, you did a great job. You unpacked it all for us. There's a heck of a lot that went on in the markets this week, and specifically in the banking sector. So Jared, great job. Thanks so much. Well, speaking of some of the volatility this week, it wasn't only for the banks, but also for Bitcoin, or was it when you take a look at where we ended the week? But the Fed's latest 25 basis point rate hike, sending the price of Bitcoin down from nearly 29,000 to below 27,000. Now, the SEC issuing a Wells notice against Coinbase, saying that it plans to take on what is called, quote, enforcement action, and Binance suffering a 2-hour outage earlier today due to a software glitch. But the price of Bitcoin remaining relatively unchanged if you take a look at where we started the week to where we ended the week. Still close, just below 28,000, right around 27,500. But certainly you can see in the chart lots of volatility, but ending the week not too far from where we started on Monday.
All right, now a bonus story you might have missed and a store you might miss dearly. Is Blockbuster Video making a comeback? The movie rental retailer has a live website, yes, blockbuster.com. The company ceased most of its operations in 2014, but fans believe the website could be evidence that Blockbuster might be making a comeback. Earlier this month, the company joked about reopening in a tweet saying, quote, "New business idea. We're going to come back as a bank and use VHS and DVDs as currency. Time to go visit your mom." The tweet was a joke, but 3 days later, Twitter users realized Blockbuster's website was once again active. And if you check it right now, it reads, "We are working on rewinding your movie." There was once more than 9,000 stores. Yeah. There remains just one.
Just one store in Bend, Oregon. And you talk about the fact that there was 9,000 stores at one point. That really points to the fact that Blockbuster is so recognizable, that nostalgia play. It's always been able to kind of play into it when we talk about this one store and the fact that it still exists today. And when this one store, most of the sales, all of its sales really comes from the merchandise within it. But the fact that people are going out and spending merchandise that says Blockbuster really tells you the strength of this brand. I don't know exactly what is going to happen with Blockbuster. If you were to get an actual VHS or DVD right now, I wouldn't have anywhere to play it.
That's the problem. Yeah. You'd have no DVD player even in your home, maybe in your car. That may be the only place we still have DVD players. Yeah. But I still do feel very nostalgic for it. So many great memories of bringing my kids to the movie store, walking up and down the aisle and buying some popcorn and candy. You probably don't even have those memories.
No, I do.
Not with your kids.
They do. No, not with my kids. No.
But I guess you would in back in high school.
Yeah, I was going to say, actually, it's so much easier now with the kids. You just put them right down. You put up all the selections on the screen. They pick one out and you hit play right away. But
it is.
I do remember going to it as a kid. Lots of fun, especially Friday night and Saturday nights when you got to pick out the movie. I get it. And then all that hype around the ad that aired right around the Super Bowl that actually drove a lot of the sales at this Blockbuster store in Oregon. And it was
an Instagram ad. They got more than 120,000 views on that. But let's be honest, they will forever be the business story about failing to make the turn, about failing to adapt and see what's coming. Remember, they could have bought Netflix for $50 million back in 2000. and cornered the market. Oh man, I don't know if there will ever be a greater example of a business that failed to make the turn.
Yeah, I'm trying to think of one right now. Nothing comes to me at the top of my head, but certainly it is just remarkable. The fact that they didn't see it, the fact they didn't see that shift. And you talk about the valuation of Netflix right now. That is a decision that a lot of people, those executives, I'm sure, certainly regret. But there is a documentary up right now in Blockbuster. The focal point of it is also that one store in Bend, Oregon. And the success of that documentary speaks to the fact that this brand is just so
I know you were looking for the number.
Yeah.
Market cap, 146 billion of Netflix. Wow. Could have had that for 50 mil.
Yeah, that was a good deal at the time. All right, well, it is closing time here at Yahoo Finance. Let's get you caught up on the biggest headlines of the day. Shares of Deutsche Bank tumbling significantly earlier in the trading session after a spike in credit default swaps on Thursday night has proven to be a warning sign maybe for wary investors following the recent collapse of Swiss bank Credit Suisse. Now, Deutsche Bank shares ultimately bounced off the lows of the day, still though ending the day down about 3%.
Meanwhile, a pair of other key events continuing to reverberate across Wall Street. TikTok CEO Shou Chew facing plenty of criticism during his testimony before the House Energy and Commerce Committee over issues of national security on Thursday. FCC Commissioner Brendan Carr adding on to the TikTok criticism. Here's what he told us earlier today.
Any worse for TikTok. I've personally sat in that exact same chair, the exact same hearing room for the exact same committee multiple times, and I've never seen anything like it. It really united Republicans and Democrats. Whatever odds are that people were putting on an outright ban on TikTok before that hearing, I think you had to substantially raise those odds during the hearing. The one thing he had to do was establish some level of trust with the committee, really with anybody, and he failed utterly in doing that.
This all comes at a time when several lawmakers from both sides of the aisle are pushing to ban the app in the U.S.
And finally, the Fed announcing its 9th rate hike since March of last year on Wednesday. Jerome Powell's comments that the inflation fight is far from over, dragging the Dow down more than 500 points lower during Wednesday's session. One of the reasons why we saw the drop in the markets that day. But for the week, the Dow, S&P, and Nasdaq all eking out gains. Well, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in. Have a great weekend. We'll see you right back here at 3 p.m. Eastern Time on Monday.